Good afternoon and welcome to Biztech's Asian Midday Market Watch. Our guest today is market strategist Leon Li, analyst at CMC Markets out of China. Now, Leon, welcome to the show.
Hi. Hi, Brian.
Now, before we get your insights, Leon, let's take a quick look at how crypto markets are performing and then take a look at how regional markets have performed this morning. We start with Bitcoin, which is at 39,628.2. It's down 4.82%. Ethereum is at 2,602.82. It's down 3.53%. Now, moving across to regional markets, we start with the SGX. It's 3,238.14. It's up 1.34%. The KLSC in Malaysia is at 1,578.55. It's up 1.04%. Shanghai is at 3,318.55. It's up 1.91%. The ASX All Ordinaries, it's at 7,417. It's up 1.16%. The Nikkei is up very sharply, almost 4% at 3.87%. It's now at 25,673. The Hang Seng is at 20,837. It's up 1.01%. And rounding up the numbers, after the close yesterday is the Kospi, which is at 2,668.31, up again 1.75%. So Leon, tell us, it's a sea of green today. What's the reason for this good market performance?
Wow, it's a very tricky price movement from yesterday, and we can see that there are huge rebound for the global stock markets. But now we can see that we need to focus on what's the emotion for the markets. Now we can see that yesterday, the gold experienced a big falling from the daily high of the US 2059.25 to the daily low of the US 1976.33, down more than, we know that more than $80. So well, it's very tricky. Now taking back all the gains on the March 8th. As the opening of the Thursday morning, gold continued its weak trend when it rushed to nearly 2,000. Quickly fell by nearly $30. Now the current price is moving above 1970. Looking back on the trend of the gold this month, the overall strong market was driven by the market risk aversion. So now the war and the strong Western sanctions against Russia push up the rapid rise of the gold price. So now we can see that the global stock markets mainly decreased in the recent days. But yesterday evening, the ruling party of the Ukraine made its first statement on the state neutrality of the Ukraine. Ukraine's ruling People's Public Servant Party issued a statement saying that now Ukraine is unlikely to join NATO in the next few years, and proposed that Moscow legally recognize Ukraine's state status and guarantee its independence. Zelensky also said on the 8th that he had no hope for Ukraine to join NATO. Looking back on the trend of the gold this month, the overall strong market was driven by the market risk aversion. Now the war and the strong Western sanction against Russian push up the rapid rise of the gold price. But the next round of the talks between these two countries will be held in Turkey. The attendees will be the foreign minister, and on the same day, the Ukraine President Zelensky said that Ukraine was preparing for the next round of negotiations with Russia to achieve peace. Judging from the current situation, the two sides are committed to the trend of resolving disputes by diplomatic means. Ukraine is unlikely to join NATO, so the duration of the war may not last too long, I guess, which will have a great impact on the risk aversion as assets like gold, US dollar. So we can see the global stock markets have a great rebound, such as the Europe stock markets like the Germany DAX 40, the France CAC 40. Any favorable outcome of the next negotiations will continue to give power to the rebound for the global stock markets, and will limit the rise of the gold. Now, so this is the main reason, and now we can see the next very huge market movement, and the product is the oil. International oil prices have also suffered a huge pullback yesterday. The WTI crude oil hit a daily low point of 104.54 US dollars per barrel during the day, and finally fell 12%. Brent oil hit the daily low 107.59 US dollars per barrel, down 13.2%. This is the largest one-day decline in the history. At present, now we can see the WTI crude oil move around 110. The easing of the sentiment has also hit oil prices. The surge in oil prices is mainly due to the escalation of the tensions and OPEC's restrictions on increasing their production, as well as Western sanctions on Russian oil. But at present, this trend may change in the short term. Facing the problem of the supply shortage, many countries like the United States are gradually releasing their strategic reserves. United Arab Emirates also called on OPEC to increase oil production. At present, the Saudi Ministry of Energy has not responded, so whether to increase the oil production depends on Saudi Arabia and Russia. Germany also voiced its opposition to the EU's exclusion of the Federal Reserve Bank of Russia from SWIFT and to the import ban on Russian oil. If Russia's energy is cut across the board, it will be difficult for the EU to find sellers, the next sellers which have the same production as Russian in a very short term. So which will further increase the EU inflation. At this time, when the global energy supply is tight, Canada's Natural Resources Minister said that the government is studying how to provide more oil to Europe, but this is very limited. The geopolitical tension, energy sanctions, and restrictions on productions by OPEC may have pushed oil price to a 14-year high. We can see the price is very ridiculous, but this phenomenon will not continue this year, I guess. The duration of the oil is limited. The impact from the COVID-19 will be smaller and smaller in the next half of the year, and the global demand surge. So OPEC will gradually increase the oil production, and the output of the United States will also begin to rise gradually. So therefore, oil prices are now in a sign of accelerating to the peak. But now in the short term. So the main question, the next section, we will discuss whether the bottom of the global US stock or global stock markets like the US stocks appear. After yesterday's rebound, the US stocks are still at the bottom of the consolidation trend. Next week, we need to focus on the Fed meeting, whether we'll regain the driving force of the market sentiment. Considering the cautious sentiment before the major events, US stocks may still have a risk averse, so the investor will sell their stocks after a rebound. Therefore, it may face the trend of falling back again to build a bottom. But in the long term, raising interest rates does not mean that the US stocks have begun to bear. The two interest rates, we can see the history cycles of the Federal Reserve in the 21st century are from the June 2014 to June 2006, and from December 2015 to December 2018. From the historical trend, the US stocks have shown a continuous upward trend. Yeah, so now we can see in this trend, during these days, the current inflation in the United States is at nearly 14 years high. So the pace of this round of the interest rate hikes will be faster than before. Therefore, it may be difficult for US stocks to show a strong upward trend this year. But however, the probability of rebound is high after the Fed raises interest rate like the next week. If the Fed's meeting, they raise the interest rates to 25 basis points, so we can expect a rebound for the US stocks. Yeah, but if inflation cannot effectively fall after the first interest rate hike, so the market expectation of the 50 basis points interest rate hike in May will increase, and then at that time, which will limit the rise of the US stocks. We can see now the SP 500 index now had achieved a certain degree of support, nearly 4,150. So our investors can track this point, whether it will have a very, the strong support now. So now this is my discussion for the global market.
Leon, thank you very much for your insights and thanks for coming on the show.
Yeah, thank you, Brian. See you.
Now, we've been speaking to Leon Li, analyst at CMC Markets on Biztech's Asian Midday Market Watch. I'm Brian Fernandez. Please check out our website, www.biztech.asia, for this video and podcast, as well as our social media platforms. Please subscribe and like our various platforms. Thanks again for tuning in.